Latitude Chef rescheduled its earning release, and there were rumors of insider selling. Share price plummeted more than 8% during the last 2 trading days, and as much as 5% after market today. According to a prospectus last Thursday, a number of TTCF security holders may offer, sell, or distribute up to about 39.3 million common shares and about 129,000 warrants. Based on Q2 earning report, the company currently has around 82 million shares outstanding. This offering accounts for almost 50% of company shares. Are we going to have a large selling pressure soon? Should we worry about a steep share price drop? In this video, I'm going to explain the implication of this filing and what I'm going to do next. Mr. Alpaca, business updates. The prospectus was filed according to Rule 424b3, which was a supplement to S1 amendment filed a few days ago. Form S1 is the initial registration form for new securities required by the SEC for public companies that are based in US. Any security that meets the criteria must have an S1 filing before shares can be listed on a national exchange, such as New York Stock Exchange. So basically, securities must be registered to SEC with S1 form before they could be traded in public market, and the prospectus we are talking about today is just an update of registration. In the case of TTCF, the unregistered securities were 1. Founder shares, 2. Holdback shares, 3. Private placement warrants. Let's first talk about the founder shares and holdback shares. If you have been following TTCF long enough, you probably know that TTCF went public via SPAC merger in October 2020. The two parties before the merger were Sprout Merger, the shell company, and MiYoYo, the physical company. Behind Sprout Merger was David Boris, or the sponsor, and behind MiYoYo were original shareholders of the plant-based food factory. Based on 10Q filing of 2020 Q2, 5 million founder shares were issued to sponsor David Boris before merger closing, and 5 million holdback shares were issued to MiYoYo shareholders after the closing date. Two parties agreed not to transfer or sell these shares until one of the following conditions occurs. A. 1 year after the completion of merger closing. B. If share price equals or exceeds $12 per share. As the share price trades well above $12 per share since went public, the second condition has been triggered. That's why the company makes update from time to time about the registration. It could be otherwise be referred as lockup expiration, which you may be more familiar with normal IPOs. Now let's talk about private placement warrants. Based on 10Q filing of Q2 2020, by the closing of the merger, the company offered 655,000 private placement units to the sponsor and the underwriters. Each unit consists of 1 common stock share and 1 warrant. Each private placement warrant is exercisable to purchase 1 share of Class A common stock at an exercise price of $11.50. There are some conditions before the warrants could be exercised. The underlying shares of the warrants must be registered with the SEC, and the share price must be above $18 per share for any 20 trading days within a 30 trading period. In a word, the prospectus provides an update of a securities registration to SEC. It gives the right but not the obligation to sell the securities listed in a filing. Here are a few questions related to the filing. 1. Is this a share dilution? No, the prospectus registered existing shares and warrants owned by shareholders. No new shares would be issued during the transfer of securities, and the proceeds of potential transaction go to the shareholders instead of the company. The only thing that would cause dilution here is if the warrants are exercised after the transfer, but it has nothing to do with the prospectus. 2. Should I worry about insider selling and a huge drop of share price? No. Large insider selling is very unlikely since it is not the first time securities were registered for sale, and the only sales were from Sam Galati as a loan payback and gift. In April this year, Sam transferred 800,000 shares to certain lenders in satisfaction of personal indebtedness at the price of $10 per share, and 500 shares in a bona fide gift. The only institution mentioned in the prospectus that had reduced the holding was UMB Capital Corp. But the trim happened in June when the share price was 35% higher. It makes no sense for UMB to dump more shares when the price is lower now, while fundamental is way better. There could be many reasons as why earning release is delayed. It could be a technical problem or negative earnings surprise, and stock may have short-term sell-off. Long-term investors should focus on business fundamentals and ignore noises. Remember, this man is still holding 39% of the company, and I believe he is leading the company towards the right direction.